Welcome everyone to the first Maple Debt Stack. So this is going to become a podcast available wherever you get your podcasts. So Apple Podcasts, Spotify. But today we're going to host this is going to be the first that we host of these, which will be bi-weekly, so every 2 weeks. And the goal here is to provide a finger on the pulse of crypto credit markets. So in doing this, we want to inform and educate capital allocators, as well as other protocols on how we at Maple see the market. So there's a ton of podcasts out there, but so far we haven't found any which are hosted by teams on the ground underwriting and actually focusing on credit markets in crypto and liaising with users directly day in, day out. So Quinn and I are going to host this every 2 weeks. We'll cover lending market topics. Sometimes we'll bring on special guests to talk about capital markets in crypto. And today, as this is the first one, what we're going to do is cover the top news stories in crypto lending, then the capital markets update, the latest at Maple, and then in future, perhaps we'll also take questions from the audience as well. But with that, let's take it away. So, looking at the top news stories in crypto lending, Quinn, starting with CeFi, what have we been seeing?
Yeah, so this one's a little couple months old now from earlier in the summer, but the Coinbase Hut8 deal was a pretty, I think, interesting and important one for the industry. It's the largest loan issued probably since early 2022 when some of the miners were getting other types of financing.
Definitely for the whole of this year, wasn't it? And so it was what, $50 million deal taken in 3 tranches, and it looks like there's a component there that's funding an acquisition of US BTC. So it's pretty big deal, right? Like 1 year facility. What were they paying on this one though?
Yeah, so it's priced at Fed funds rate plus 5%. So the upper bound is about 10.5 at today's rates effective. And it's very similar and kind of lends credence to what we're doing on the direct side with the over collateralized lending, given a lot of these miners and businesses in the space that hold maybe less BTC and are less profitable, they're seeking finance against these assets. So good one to see the credit markets thaw a bit and some new debt capital flowing in, and then hopefully we can help put together a few more like it.
Yeah, definitely. And not moving off M&A too quickly, there's, of course, the Fahrenheit debt transactions, which is the Celsius estate. And what we've got here is, it seems like there is a loan book. We've got multiple lenders here who are crypto focused, who are bidding on this loan book and who effectively want to take on the refinancing of it. But it's a pretty big book, isn't it? It's what, 410 million so far? And how much is the collateral backing that worth?
Yeah, so it's like you said, $410 million in total loan value, stablecoin loan value or dollar loan value, and it's backed by $760 million of digital asset collateral. So, as part of the Fahrenheit Celsius, restructuring, this loan book of 23,000 outstanding loans from the retail business, stemming from $1,000 all the way up to the largest one that in the filing said was 14 million. So some high net worths in there. The lenders are competing to refinance these.
And who's competing? We've got some pretty well-known figures in the space and some new ones. So you've got Salt, Arch, Ledden, and Figure by the looks of it, all offering roughly kind of similar terms, albeit some slight differences. But roughly, where's the pricing shaking out? What is it? It's kind of 11, 12 mark?
Yep. So yeah, duration 1 to 2 years. I think the rates headlines stem from 10 to 12%, and some of them have 1 to 2% upfront administration fees. And so they're basically competing for this book of business. I don't think all 400 probably gets refinanced, but probably a meaningful chunk, depending when these loans were taken. And it's definitely an interesting because we're speaking with some of these providers who are bidding, and although we wouldn't be facing the consumers directly, that's just, we're institutional. That's not part of our business. We can provide the financing to allow them to compete and bid for these assets and provide that USDC funding.
Yeah. And full disclosure, we have a relationship with at least one of these, and but we do speak with them. And I think it's interesting for us. I mean, our vision with Maple was never to really be a consumer lender ourselves, but we wanted to be the kind of the wholesale finance that powers them on the back end. And so we would love to take down a chunk of this, or help help one of these guys refinance some of these loans and build their own book, ultimately build their business and help get to scale, whilst we, provide wholesale finance on the back end. And it was all over collateralized, isn't it? Like, none of this stuff is under collateralized. So you're looking at about what, 170 to 190% collateral.
Yep, it's high quality exposures, and at those rates, it's pretty attractive from a lender's perspective. I think, this just goes to show how big the lending ecosystem was at one point, and will be again.
Yeah.
This is part of the broader Fahrenheit case. They have still a couple $100 million institutional loan book of performing loans, outstanding that will get ported over to the new co. So there's a lot of activity there, and these people over the coming years will need to be refinanced out, and hopefully that bodes well for the type of things we're doing.
Yeah, for sure. All right, well, let's turn over from CeFi and take a look at the DeFi market updates. So, biggest one on the agenda so far has been Maker DAO Treasuries forum post. So Maker has been an absolute juggernaut in buying treasury bills. So over 2 billion since early 2022. Most of this coming through Monetalis, who act as a ranger for the Clydesdale structure. And what did we see in the forum post? What were people talking about?
Stakehouse was really the leader of the charge here, and obviously they've been very active in the Maker community for a while, and really highlighting the benefits that tokenized T-bills are bringing. This activity on chain improves, whether that's higher transparency, the simpler accounting, less complexity, and better automation. So to me, it speaks towards the trends of growing transparency, utilization of the blockchain, and might have knock-on effects for some of their other allocations as well, just given they still have a number of these allocations and arrangers that operate off chain.
Yeah. And so there's a real push to bring a lot of this stuff on chain, effectively instant visibility on the interest being earned, asset backing, and also I guess more fungibility and kind of structure and robustness for the actual tokenized assets held by Maker DAO, which makes sense as you get larger. And I think also one component that's perhaps lost on people a little bit is diversification. I mean, once you're running a book in the billions of dollars, you probably want a healthy split, so that if something goes wrong, heaven forbid, in one of the silos, that the others are protected and not cross-contaminated. As part of this, like, there are, of course, a number of new providers in tokenized T-bills, aren't there? I think, what are we looking at? About 365 mil at the moment, and I think that's probably still undercounting it, because it's not really counting things like the Franklin Templeton Benji token.
Yeah, that's right. And that's from basically $0 in tokenized T-bills a year ago when rates were much lower. So there's obviously a big push here. Tokenized treasury bills have found product market fit in a crypto environment that has failed to provide good risk-adjusted yields elsewhere. Compound Ave are still in the 2% range. So definitely, I would expect over the next 12 months, as the sub DAOs become cemented, most of Maker's allocation happens on chain.
Yeah, I think so too. And as a little plug for friends of ours, so it's the Stakehouse June dashboard that we are reading from for this, as well as RWA.xyz has a good dashboard on the tokenized RWAs. Before we move on from DeFi, worth noting one of the other developments. So Goldfinch, who's one of our peers in the RWA lending space, had some credit events recently. So they, of course, had the $5 million Tugenda default, but it looks like a bit of a positive development there, which is great for the space, in that it seems like there's a restructuring plan going ahead, and ultimately they'll be able to get some recoveries there, which I think will either reduce the loss for the senior pool, or ensure that so far the interest earned by that pool is able to cover the full amount of those losses, which I think, positive development. We of course know that credit events happen in the space. It's unavoidable throughout a cycle. And then the other event was it was a $7 million credit event with the Stratos pool.
Yeah, that one was the most recent update on the forum, which another, I'd say, positive development for folks in that pool, being that Warbler and Goldfinch are going to be backing the losses that third parties will be taking. So some positive, remediation to both. And, I don't think either mean anything negative long-term for RWAs on chain, but rather reinstate some of the things people have noted, just transparency being key, underwriting and credit review processes being key. And the funny thing is, just having all this on chain brings it out in the open. And the alternative being, what we saw last year, CeFi and more of a black box, you probably would have never even heard about it.
Yeah, you don't know something's wrong until you hear about it, either at the time that they freeze withdrawals, so you don't hear it at the time the credit events happen, you hear it at the time you want your money back, or you don't hear about it at all and you find out months later when a regulator brings some kind of action, which we of course saw earlier this year with one of the other CeFi lenders. So wrapping up on the DeFi side of things, let's just look at on-chain capital markets. So looking at lending volumes, interest rates, collateralization, uncollateralization levels, what are we seeing when it comes to lending volumes?
Yeah, so RWA, they have the nice dashboard highlighting about 560 million in total active private credit loans on chain today, and that is comprised of the RWA stuff, Centrifuge Maker are doing, the digital asset lending volumes that we're doing, and really across the board. I think one of the things I was curious to dive in on that number is what percent are using token subsidies. A lot of it is legacy or longer duration assets that were put on the books, 1 to 2 years ago. And so I think it's very little. I think it's about 90% of that TVL number probably is using token subsidies at this point, which is much lower than what it was in the past, but I think indicative of some trends and becoming more sustainable.
Yeah. So I mean, in other words, we're starting to see that the book of loans on chain is relatively seasoned at this point, and it's kind of locked in a lot of token emission rewards that were happening. Newer loans that are coming online, whether it's tokenized T-bills or actually more of the private credit variety, typically don't have, like, the newer vintages typically don't have token emissions behind them, do they?
Yeah, exactly. That's right. And we're also seeing, on that trend of the tokenized treasury bonds, we're seeing the stablecoin issuers starting to want to compete with that market as well, and the interest-bearing developments. There's been a couple fundraisers like Mountain out of Bermuda, Athena out of Portugal, Midas out of Germany. So I think that provides some interesting competition for the existing stablecoin assets, and obviously a lot of regulatory things to sort out there. But I think that continued rise will continue to benefit the industry.
Yeah. And on the interest rates, so DeFi interest rates, we have the DAI savings rate, which has been around 5%. And this is, of course, derived from T-bills on the underlying assets. The interest on the T-bills then being paid on chain to folks who are staking DAI. But that rate came online in summer, and it's had knock-on effects, hasn't it? What has it done to the rest of the DeFi ecosystem?
Yeah, most of the year, Compound and Aave were, right around the 2 to 3%, sometimes even a little less, just given the lack of demand across the ecosystem for leverage. And the DSR was most recently a pretty important development in bringing those rates higher. And so we've seen this kind of knock-on effect of if people can hold DAI and earn 5%, via Spark and the DAI savings rate, it's really increased the cost of capital for USDC, USDT, and the knock-on across the board. So overall, crypto's had this interesting dynamic where in the past, crypto markets demand for digital dollars really boom when traditional interest rates fall. And so they've been completely inversely correlated. You saw that in 2020, 2021. And then when the Fed and traditional interest rates start rising, demand for crypto wanes and crypto interest rates actually fall. And so this is I'd say more stabilizing force in keeping the two systems more in check. And overall healthy. It might be difficult for some businesses that have relied on cheaper cost of capital in the ecosystem, but it's been bound to happen. And I think it's positive to have, almost $500 million of new assets being these T-bills running on blockchains.
Yeah, for sure. And if we look at, keeping the lanes on interest rates, secured or rather the over collateralized rate. What are we seeing there from both, I guess, the lender ask and borrower bid? We had the US risk-free rates above 5% now. What are sophisticated lenders asking for when it comes to rates?
With the risk-free at 5, it's presents a pretty compelling alternative that didn't exist 12, 18 months ago. So what we're seeing is just operating on chain, despite loans being over collateralized and providing the protection of quality collateral, keeping to the Bitcoin, the ETH, the staked ETH. Lenders are still demanding 300 to 400 basis points spread above that, and that's right in line with where our Maple Direct secured lending pool is yielding in that 8 to 9% net. And speaking with other desks in the ecosystem, some exchanges and OTC providers are undercutting that a bit on pricing, where they want to incentivize trading activity and win business in a very competitive market with lower volumes. But over the long run, I think things stabilize in this sort of 400 basis point back of risk-free for the over collateralized stuff. That's not even getting into the under collateralized or riskier lens. Yeah.
And as we look at the under collateralized or uncollateralized lending, we're not really seeing much happen there in size, are we? It's whatever exists, it's pretty small. It's probably going to be from retail depositors or maybe ad hoc lending like shareholder loans. But doesn't seem like there's a ton of volume happening in the space. Is there any activity that we're actually seeing or we could point to?
Yeah, Clearpool is one of the remaining protocols on chain that's providing liquidity. I think they have about 25 million in total lending volumes today. It's being lent anywhere from 8 to 10% plus some Clearpool rewards, token rewards. So those rates, it's interesting. It's, the borrowers on there tend to be hopefully on the higher quality side, but still I think it is a representation of a little bit of the dilemma in crypto credit, which is many businesses in the
supply
ecosystem.
Demand.
You have this capital that's on chain that people want to earn yield on, but a lot of the borrowers aren't profitable enough to pay 15%, which might be more in line with what comparable risk adjusted rate would be. So I would say we still need more demand on the borrow side to really make rates as competitive as possible.
Yeah, for sure. You and I were talking just before about how the high yield bond index still paying around 11% at the moment. But as we look to the future, I think if we saw trading volumes pick up, that's kind of where a lot of the yield derives from, right? Trading volumes on centralized exchanges by retail lead to profitability for the market makers, leads to a higher basis rate trade, and that ultimately kind of trickles through and provides the interest on the loans that are provided to these guys. What are we seeing though, as far as one final call out is Bitcoin and Ethereum as yield bearing assets holding up or not?
Yeah, I would say another big supply demand imbalance there with both Ethereum and Bitcoin being the largest digital assets on chain. So huge supply of folks ideally looking for yield on their assets. And they also happen, particularly Bitcoin, tend to be the most dormantly or longer term held asset. And so people would be happy to earn a yield, but just not a lot of demand. So the market makers would be the segment to power that the most. Maybe some miners looking to forward hedge production, but ultimately still, we're seeing some deals go in the mid single digits. And to me, it doesn't feel like a great risk return for if you're parting ways with your Bitcoin. Maybe on a fully collateralized basis, I can understand if you have that security protection, maybe collateralized by dollars or another digital asset. But on an unsecured, it's a bit light, I would say. So I think those assets are just pretty volatile.
Yeah. And do you think it's also perhaps people reaching for yield? Like we're in a bit of a sideways market. They're not getting the capital appreciation, expenses, inflation, opportunity cost in other parts of the market is kind of going up. And so people are reaching for yield and they're kind of, you know, willing to take unsecured credit risk on it, I suppose.
Yeah.
At least on Bitcoin and ETH.
It could increase too as the staking rate comes down. So Ethereum staking rate's now below 4, probably in 12 months it's below 3. And, if activity on chain doesn't make that higher, we definitely could see people wanting to lend to start earning higher yield than that.
Yeah. Makes total sense.
Yeah, I think that covers it on the capital markets and news side. And we want to make sure we left a little time to just touch on some of the updates we have on Maple. Maybe in the future, this will include some special guests to hear about new things being built in this place. But yeah, Sid, I wanted to talk about why we're really excited about Q4 and some of the positive things in Q3 that happened.
Yeah, for sure. So Q3 for Maple, what did we see? So by the end of the quarter, TVL was up over 70 million, and this is up from 40 million at the end of Q2. And at the start of Q2, we were probably sitting at about 16 or 17 million. So we've more than 4x'd it since then. 61% quarter-on-quarter loan growth in underlying loans outstanding, and you can actually go and see that on the new dashboard that we built and put up on June. So if you go june.com/maple-finance, you'll be able to see that. We'll post a link in the show notes. And then 90% quarter-on-quarter growth in annual recurring revenue. So protocol revenues at about 450K. And a lot of that is being driven, one, by the growth in the Maple cash management pool, but more so by the growth that we saw in accrue. So the accrue tax, which is effectively tax receivables, advances or factoring, that grew 60% in August from 10 to 16 million. And then Maple Direct, which was the new direct lending line, which is over collateralized, got up and running and now has over 8 million loans outstanding there. So healthy growth there as well.
Yeah.
Onboarding pipeline. Sorry, go ahead.
I was going to say, we'll touch on it with the onboarding stuff, but some of the interesting facts on the on where that TVL is coming from and withdrawals.
Yeah, definitely. So I think ultimately we had about 60% was new lenders coming through. So which means the appetite is widening, and we actually only had 4 million in net withdrawals for the quarter. So I think this validates the kind of the portfolio thesis that you want to have multiple different offerings on a platform, because sometimes folks, while they're waiting for a new direct loan, will go into the cash management pool where they just want to get the T-bill exposure, and vice versa. If they want to go risk off, maybe they come out of one of the direct lending pools or private credit pools and they go into a cash management pool. So it's nice to have that diversification, because people aren't, there's not a one size fits all for lending appetite here. But Direct's off to a pretty good start. Why don't you tell us about it?
Yeah, so we issued the first 2 loans out of the pool over the last few weeks. We actually have the next one coming next week. And yeah, we're just looking to continue to capitalize on the momentum there. So 2 weeks ago, we did a $8 million USDC loan to a large crypto native institution collateralized against their high quality digital asset holdings. Deal was heavily oversubscribed from our lender network. And we actually even had to pare back a few allocations to make sure it fit everybody in. But we'll be able to satisfy those allocations with the next one. And we had a pretty broad participation base. So 10 different lenders ranging from yield funds, some trading shops, some high net worths, and even a few market makers who we've worked with in the past who are sitting on excess cash from their business that we're looking to deploy and earn yield.
Which is, of course, one of the indicators of subdued trading volumes. Once we see those guys flip from lending on the platform to going back to wanting to borrow, it'll be a good indication that that trading volumes are back and profitability for market makers is back. But this secured pool or secured over collateralized loans pretty unique in the DeFi space. What's happening there that kind of sets it apart from what else is out there?
Yeah, it's really, it boils down to a lot of the structure and forms of legal agreement, documentation. That's all similar to traditional loans and lending agreements, enforceable in court, security agent. But the Maple smart contract
What's the
infrastructure.
major difference?
Yeah, exactly.
Smart contracts.
The on-chain. So, we have the loan infrastructure on-chain, and then the collateral is held at a qualified custodian. And so when a borrower posts that collateral, one of the reasons they get comfortable working with the Maple Direct Pool is their collateral is held in unique segregated accounts at the qualified custodian, and it's prohibited from being rehypothecated, which is not the case in most lending arrangements. And so they're getting that surety of mind, knowing they're posting significant over collateral than the actual loan proceeds they're receiving. But everything's done transparently. Interest is paid on chain via the smart contracts, and it creates a much more efficient environment to work and deploy capital.
Yeah, and the rate's pretty competitive, 8 to 9% net of all fees, with roughly 200% plus collateralization. So prime rate in TradFi is about 8.5, and so you're making that, albeit shorter term exposure with significant over collateralization, rather than reliance on kind of the credit worthiness of your counterparty. Though the credit worthiness is pretty good, like that's definitely factored in the underwrite here. So what do we got next? What do we got coming through the pipeline next for Maple?
Yep.
You talked a bit about the other deal coming through.
Yeah, the nearest term is going to be this new deal out of the secured lending pool. So that'll be our third borrower out of that, expecting it to close by the end of this month, hopefully next week. And yeah, now that we're 1 to 2 months post-launch, we're also starting to see traffic increase around inbounds or in other financing verticals and opportunities, both within crypto, but around RWA types of deals as well. So we expect to continue digging in there, and hopefully should have some other new pool announcements or loan deals available to the lender base shortly. And one of those that we're actually been working on for a bit now is the upcoming launch,
which is the Cicada pool, isn't it? So we've got a team of folks that we're pretty familiar with. So Sefton, Christine, and Christian, the co-founders of Cicada, who will be working with Monetalis, also big name in the space, but these guys come from TradFi backgrounds. Sefton, ex Aberdeen, Christine, previously working in banking, a lot of institutional client coverage, and they're launching a pool that is going to be focused on relatively conservative allocations. So I think we'll have more information coming out about that over the coming weeks. But think of this as like Treasuries plus, so asset-backed securities, Treasuries, and some other assets thrown into the mix, but relatively conservative. And we're pretty excited about that. And then what else do we have going on at Maple? We Q3 we had the big launch of Cash on Solana, and we're now pushing 40 mil TVL in that product.
Yeah, total is right around 40, continuing to increase week over week. And talking about that Solana launch for a second, we basically, we obviously were operating on Solana in the past, launched there originally in 2022, and facilitated now over 200 million in loans on Solana, but had paused operations there for a bit until this launch. And so really from a cold start, we're up to close to 8 million in the tokenized T-bills and onboarding a few more counterparties to deposit there. So that's been a big hit, and we've been getting active, in the Solana community again. And it's really fascinating to see all the developments there. I think, Sid, you're going to be boots on the ground at Breakpoint.
Yeah. Speaking on an RWA panel at Breakpoint in Amsterdam in the first week of November. So I think it's November 3rd. And you're right. We are seeing a lot of, so the VCs we talk to are seeing a lot of deal activity happening on Solana. Ecosystem has remained pretty healthy. Founders there are high conviction, and so we want to have this product available to support them for their treasuries. They want to continue managing on-chain stablecoin denominated treasuries on Solana, and so we want to provide a product there and hopefully evolve that over time as the ecosystem continues to grow. But quite bullish on it.
Yeah, and I think the other thing just to call out on the cash management product is the upgraded liquidity that we'll be rolling out, and we think is a big differentiating feature versus some of the other products in the space. So maybe
what are we doing there? Yeah, we're doing queue-based withdrawals. So currently, as with everything in crypto and DeFi, the UX is a little bit janky at the moment, and you have to signal your intent to withdraw, and then come back and actually withdraw. What we're going to do with this Q-based withdrawal system is you just say, I want to withdraw, how much you want to withdraw. And then as soon as liquidity comes in, it'll be transferred to your wallet. So you just see it drop in without having to come back and actually, execute that second transaction. So nice improvement there for liquidity, much easier, particularly if you're running a DAO or a multi-sig. You don't want to have to arrange, 5 signatories from your DAO to make that withdrawal. So pretty happy about that. Differentiation is key with, what are we up to? About 10 different treasury T-bill providers. So we've got to stand out. And what else are we going to have coming in the future? More RWAs on the horizon?
Yep, more RWAs, probably some more crypto native lending, more partnerships. We've spent Q3 building a lot of different integration pathways and some partnerships things. So more announcements on that front, and yeah, continue to try and thaw these credit markets and continue to add financing to the ecosystem.
Yeah, for sure. And I think, on the other RWA front, like really what we're looking for is higher yield, shorter duration, US or European based assets, I think is where the lender demand is heading. And on the partnerships, who knows? Maybe you could even see Maple launch on one of the up and coming L2s these days. But folks will have to stay tuned for the second episodes. I think it's a good place to wind up the first episode of the Maple Debt Stack. We will have a lot of all the links in the show notes for folks. And we hope you can tune in again with us in 2 weeks' time. And also, don't forget to send us some questions. All righty. Thanks, guys.
Thanks, everybody.